$5,000. Let that number sink in for a moment. Gold just crossed a threshold that most analysts said wouldn't happen until late 2026, and it's doing it right now this week, with silver right behind it at $78 an ounce. If you've been watching metals for the last decade, you know what this moment means. Before we go any further, I need to be very clear with you. Everything you're about to hear is for educational and informational purposes only. Nothing in this video constitutes financial advice, investment advice, or a solicitation to buy or sell any asset. I am not a licensed financial advisor. Always do your own research and consult with a qualified professional before making any investment decisions. Markets are volatile, and past performance is never a guarantee of future results. With that said, let's get into it. My name is Bernard, and if you followed this channel for any length of time, you know I don't chase headlines. I track structure. I track data. I track the kind of patterns that institutions watch but rarely talk about publicly. I've spent years studying how precious metals behave at inflection points, and right now we are sitting inside one of the most significant inflection points in the history of modern commodity markets. So let's talk about what actually happened this week, what the data tells us about Friday's likely movement, and why the so-called Thursday crash pattern may have just been permanently rewritten. Gold closed above $5,000 this week. As of February 20th, 2026, spot gold is trading right around $5,031 per troy ounce. According to live market data, silver is sitting at approximately $79.15 per ounce. These are not projections. These are real numbers right now, today. And the speed at which we got here is what should be commanding your attention. To understand why this matters, you have to go back to where we started. Gold opened 2025 at roughly $2,600 an ounce. Silver was around $30. What followed was not a speculative bubble. What followed was a structural revaluation driven by forces that had been building quietly for years and then converged all at once. The Federal Reserve began cutting rates throughout 2025, bringing the federal funds rate down to a range between 3.50% and 3.75% by December. That shift in monetary policy removed one of the key headwinds for gold, the opportunity cost of holding a non-yielding asset. When rates fall, gold becomes significantly more attractive relative to bonds and cash. But rate cuts alone don't explain a move of this magnitude. The deeper story here is central banks. Central bank demand for gold is projected to remain elevated, with approximately 755 tons of purchases expected in 2026. Still historically high compared to pre-2022 averages that hovered between 400 and 500 tons per year. JP Morgan. These are sovereign institutions making strategic decisions about reserve composition, and they've been consistently buying at levels the market had never seen before 2022. That is not noise. That is a structural signal. Simultaneously, global ETF flows reversed dramatically. Gold ETF buying jumped by 222 tons in the third quarter of 2025 alone, marking a sharp reversal from the outflows seen in previous years. Kavut retail and institutional investors who had been sitting on the sidelines during the rate hike era came back into the market decisively. The demand picture became overwhelming relative to available supply. Silver's story is even more nuanced and, frankly, even more compelling from a structural standpoint. The silver market entered its fifth consecutive year of structural deficit in 2025, with global supply failing to keep pace with accelerating demand from green technology and digital sectors. Mine production has actually declined from roughly 1.07 billion ounces in 2010 to approximately 1.03 billion ounces by 2024 and 2025. Kavut. Here's the part most casual observers miss. Most silver is mined as a byproduct of copper, gold, lead, and zinc operations. That means miners cannot simply ramp up silver production when prices rise. The supply response is structurally constrained in a way that most commodities are not. You combine that with surging industrial demand from solar panel manufacturing, electric vehicles, AI server infrastructure, and healthcare technology, and you have a market where the math simply doesn't balance. JP. Morgan Global Research sees silver averaging $81 per ounce across 2026, noting that silver rose by more than 130% over the course of 2025. JP Morgan. Now let's talk about what happened Thursday and why it matters for Friday. For much of the past 2 years, there has been a recognizable pattern in precious metals, particularly gold, where Thursday sessions carried above average volatility and, more often than not, a downward bias. This was driven in part by options expiry mechanics, in part by institutional repositioning ahead of weekly closes, and in part by algorithmic systems front-running anticipated weekend risk reduction. Traders who understood this pattern had learned to be cautious on Thursdays. Some were selling into strength on Wednesday just to avoid Thursday exposure. This week, that pattern broke. Gold did not pull back on Thursday. It held above $5,000, and critically, it did so on volume. That is not a small detail. When a pattern that the market has relied on for positioning purposes breaks and breaks convincingly, it forces a recalibration across the entire participant base. Traders who were short expecting the familiar Thursday dip got caught. Institutions that were waiting for a dip to accumulate started moving. The feedback loop becomes self-reinforcing very quickly. What does that mean for Friday? It means we should expect heightened activity and potentially heightened volatility, but not necessarily in the direction of a sell-off. The psychology of the market has shifted. When a long-standing pattern fails, confidence in that pattern evaporates, and the next session often sees exaggerated movement in the direction of the break. The path of least resistance based on the week's price action and the broader macro backdrop remains higher. That does not mean straight up. It means the underlying bid is stronger than the overhead supply at current levels. Professional analysts surveyed by the London Bullion Market Association now project gold's 2026 trading range running from a low of 3,450 to a high of 7,150, while silver's forecast range stretches from $42 on the low end to $165 on the high end. Bullion Vault. The width of those ranges tells you everything about how much genuine uncertainty exists. But what's notable is that even the most conservative forecasts have adjusted dramatically upward compared to where consensus stood just 12 months ago. JP Morgan expects prices to push toward $5,000 per ounce by the fourth quarter of 2026, with $6,000 per ounce a longer-term possibility. JP Morgan. We're already at $5,000. That's how far ahead of schedule this rally is running. There is one wild card that deserves serious attention, and that is Federal Reserve leadership. Chair Jerome Powell's term expires in May 2026. The nomination of his successor, whether dovish or hawkish in orientation, has the potential to temporarily reshape the trajectory of real yields, and by extension, gold's near-term momentum. A more hawkish appointment could create a genuine headwind. A dovish successor would likely accelerate the debasement trade further. This is a known unknown sitting on the calendar, and sophisticated market participants are already pricing tail risks around it. What I'd caution against is treating this moment as an invitation to chase price without understanding the risk structure. Silver at $78 after a move from $30 in 12 months carries very different risk parameters than silver at $30. The same is true of gold at $5,000. The bull case remains intact, structurally, fundamentally, and technically. But markets that have moved this far, this fast, will have corrections. They always do. The question is never whether a correction will come, but whether the structural thesis that drove the rally is still valid when it does. In this case, the evidence says it is. That is where we stand as of this Friday, gold above 5,000, silver pressing toward 80, a Thursday pattern broken, and a macro environment that continues to favor hard assets as institutional confidence in fiat currency systems slowly and steadily erodes. I'm bernardOGanalyst. I don't tell you what to buy or what to sell. I give you the framework to think clearly in a noisy market. If this breakdown was useful to you, share it with someone who's trying to make sense of what's happening right now. Stay patient, stay informed, and always protect your downside before you reach for the upside. I'll see you in the next one.